Welcome to Creating Wealth with Jason Hartman. During this program, Jason is going to tell you some really exciting things that you probably haven't thought of before, and a new slant on investing. Fresh new approaches to America's best investment that will enable you to create more wealth and happiness than you ever thought possible. Jason is a genuine, self-made multimillionaire who not only talks the talk, but walks the walk. He's been a successful investor for 20 years and currently owns properties in 11 states and 17 cities. This program will help you follow in Jason's footsteps on the road to financial freedom. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Good afternoon. This is Jason Hartman with Platinum Properties Investor Network, broadcasting today's podcast number 18 from the OC here in Orange County, California. Today I would like to talk about inflation, but really I'd like to talk about leverage, but leverage specifically as it relates to the concept and the reality of inflation. When you use leverage or borrowed money, there are many, many benefits. The prudent, proper use of leverage, a very powerful tool, could be a destructive tool. Some people get themselves into trouble with it. But when you use it the right way, especially when investing in real estate, it is an incredibly powerful tool. The main benefits, although there are many others, and in our other podcasts you hear us talk about leverage, is to reduce risk and increase return on investment. However, this podcast is specifically geared toward inflation. In fact, I call it the Great Inflation Payoff. Now, if you ever have a chance to attend one of our seminars or meet or talk with one of our investment counselors, they will be glad to run some phenomenal inflation calculations for you. And these will show you how much benefit, yeah, that's right, I said it right, benefit you are actually getting from inflation as a real estate investor. So let me just say this to make it simple. Think about this. If you were to purchase 6 single-family homes and the aggregate value of those single-family homes was $1 million, and if you were to put 5% down on those properties, assuming you could qualify based on 5% down, your loan balances would be $950,000. Think about this. If inflation is 4%, in 1 year, if you've paid down no principal whatsoever, your loan balance reduced just because of inflation to just $912,000. Essentially, inflation paid off, if you will, $38,000 of your loan balance for you. This is what we call the Great Inflation Payoff. Borrowed money offers those two great benefits, reducing your risk and increasing your returns. But better than all of those is the benefit of inflation, because better to borrow money today and pay it back later than to pay money back today. And real estate has some especially beneficial features with inflation, because what happens, think about it, our rental properties, the loans on them, the debt on them, is paid back by our tenant rather than by us, or at least as much as possible the tenant pays off our loan balances for us. So more on this later. I'd like to just play for you part of a recent live seminar where I talk about the Great Inflation Payoff and some of these benefits of inflation. Now also, you have to understand that since you cannot see the visual aids being presented, you may have a question or two that is apparent and obvious to the live audience. So just give any of our investment counselors a call. They'll be glad to give you visual aids or explain things in more detail to you. And I will be back at the end of this podcast to tell you more about the inflation payoff and just sort of wrap this up. Thanks for listening, and let's tune in to a recent live seminar. Now let's talk again about inflation. If you go onto Google and type in inflation calculator, you can find these all over the internet. These are just 2 screenshots of inflation calculators that I found typing that into Google. So Remember, I asked you earlier today, would you rather have $100,000 today or $100,000 in 10 years? And everybody said today they'd rather have the money. And then I asked you, would you rather pay $100,000 today or pay it in 10 years? You all said, I'll pay later, take it today. Right answer, definitely. If you have a $100,000 mortgage on your property, and say it's an interest-only loan, we're not paying the principal down, it's just interest only, and it's a 10-year loan. If you believe, which you'd be crazy to believe it, but if you believe that inflation is only around 4% a year, as the government would have you believe, then after 10 years, if your loan is interest only, your statement still says $100,000 on it. But remember, you're paying in depreciated future dollars. So you're really only paying back $66,000 10 years from now. Better to pay later than to pay today. What if inflation is 8%? Personally, I think it's 10 to 12%. That's my opinion. $100,000, 8% inflation, 10 years go by, you're really only paying $43,000 in 2017 dollars. So debt works for you really well when you're the borrower. When you're the lender, debt really hurts you. When you buy bonds, you are the lender. When you buy bonds in a company or government bonds. That's why bonds are lousy, because I don't like being the lender. You know, Shakespeare a long time ago said, neither a borrower nor a lender be. Shakespeare was wrong. Be a borrower. Don't be a lender. Lender, no, lousy. I ask you a question about borrowing and lending. How many of you have ever loaned money to a friend or family member? Who was in control of that transaction, the lender or the borrower? Like I said, be the borrower. That's where you have control. So let's look at this example. Here's the bank. You go to the bank and you say, bank, I'm a real estate investor. I want to borrow money to buy this house. My name's Donald Trump. I got a comb over, and I'm going to buy this house. And I want you to loan me the money to buy this asset. But look, bank, I'm going to own the asset. You're just financing it for me. You're not going to get any of the tax benefits. You're not going to get any of the appreciation. All you're going to get is interest on the loan. And then I think, well, this sounds like a pretty good deal for me, the real estate investor, but the only problem is I got to pay the mortgage back. I've got to pay the loan back to the bank. What if I could avoid paying the loan back? Wouldn't that be neat? So what do? I rent the house out to Heather Locklear, one of my personal favorites. So Heather becomes my tenant, and I'm going to say, look, Heather, effectively, you're going to pay the bank back for me. But it gets better than this. I borrow money from the bank, say at 7.5% blended rate. What that means in the blended rate is if I get two loans to put minimum down payment, say I do 80% on my first loan, 15% on my second loan, 5% of my own cash down. The blended rate, okay, is the blending of the two loans. The 80% loan is a larger balance at maybe 6.75%, for example. And the second loan is a more risky loan for the bank to make. So they're going to charge me a higher interest rate because they're in second position when it comes to collecting. So they might say, well, I want it 12%, but it's only a small amount of money. It's only 15% of the purchase price. So the blending of the two might come out to 7.5%. So that's the effective blended rate. All right? So I pay the bank, or really Heather Locklear pays the bank, in depreciated future dollars. Okay? And the asset historically appreciates faster than the rate of inflation. Now, most people see how they win the game in real estate this way, but they don't see how they win the game in real estate this way. You don't win one way, you win two ways, by borrowing money. The problem is, the bank isn't stupid. They understand inflation. I mean, how many MBAs are working in any bank? Lots of them, right? They went to school, business school, they learned about inflation. So they know this is out there. But they think inflation is only 4%, like the government tells us all, right? But they also realize that, look, if we want our money not to depreciate, we've got to charge an interest rate higher than the rate of inflation to offset that. So we might loan the money out at 7.5%, believing inflation is 4%, so our margin effectively is 3.5%. That's our profit to the bank, if you will. It's more complicated than that, but simplified example. So the bank knows this. So they're going to charge me a rate higher than inflation. So see, if I bought vacant land or if I didn't rent my house out, I would actually suffer because I'm not getting the tenant to pay my mortgage back for me. But we call this tenant-backed or tenant-financed debt. That's when debt is good, when someone else pays it off for you. Okay, you get the benefit of inflation. There is destructive debt, which is consumer debt. This is how people get into trouble with debt. They get into debt over the appearances of wealth. Clothes, cars, vacations, plasma TVs, stuff that depreciates in value that you can't rent out. I remember about a year and a half ago, I got a call from a gold dealer, Monix. It's a local company here in Newport Beach. You may have heard of them. And he calls me up and says, Mr. Hartman, we think you should invest in gold because all the fundamentals are right, blah, blah, blah. It's $420 an ounce now, and we think it's going to go to $1,000 by the end of the year. Well, it didn't, but it did go up. I bought it. So I said to the guy, I said, look, I will send you $5,000. You send me the 12 gold coins. And so you've made the sale, but I have 2 questions for you. I'm going to buy it, but I want to know 2 more things. Number 1 thing I want to know is, will you finance my purchase for 3 decades, for 30 years, at some of the lowest interest rates in 40 years, tax-deductible interest? And he says, we don't do that. And then I said, okay, fine, I'll pay cash. Then I want to know, can I rent my gold coins out to someone? And he says, I don't think anybody rents gold coins. See, that's why that doesn't work as an investment. Anything you can't buy, get someone else to finance for you, take huge tax deductions in between, and you have a renter generating income, is not a good investment. That's why I don't buy vacant land, because I can't rent it out. Unless it's a parking lot, I guess. That might work. But that's the reason this works so well. Don't get into debt over the butter of life. Get into debt with guns, the guns and butter philosophy. Guns are things that create wealth. Butter is the luxuries of life, the things that really diminish wealth over time. The entire tax code and the U.S. banking system encourage this. Do what they want. Play their game. Diversify your equity for greater safety. Move it out of the high-price market into the better value markets where the properties make sense the day you buy them. Constructive debt is investment-grade debt, okay? J. Paul Getty said it well. He said, if you owe the bank $100, that's your problem. If you owe the bank $100 million, that's the bank's problem. So the borrower is in the position of power. Just remember that. A couple things I want to mention to you is that during the break, Cliff came up to me and he talked about the RV ratio and why we move out of markets. Actually, when we move out of a market, a lot of times it's good news for the people that already bought there. And the reason is that the way markets play out, at least what I've noticed over the years, is that prices will start to appreciate, and then behind that you have the lagging indicator of rental income, of rents. And think about what's happening in Orange County right now. The RV ratio is typically about a 0.3. So here, $1 million house rents for about $3,000 a month. And I know that because Marcus sold his house, Marcus Milliton, who was just up, and rented one, and he rents a house that's worth about $1 million for $3,000, I think $3,100 a month. And it was really a good idea to sell his house. Now, he has 4 kids, and his wife, Marjorie, just about had a fit when he said, we're selling the house in Ladera Ranch, and we're going to go rent. Huh? No, we're not. I'll call my attorney. But really, it is a much better deal to rent a house here right now than to own one at the moment. So what happens is you'll see the prices appreciate. That's the leading indicator. Then you'll see the rents follow. That's the lagging indicator. So they get so out of sync. And what may confuse you is that you might read in the media right now that rents are going up. In the bubble markets, they're going up more than they are in the non-bubble markets, and that is true. But they're so out of sync here, it's ridiculous. Think about what has to happen here. The $1 million house needs to rent not for $3,000 a month, but for $7,000 a month for this market to work again. And I believe that the RV ratio is a predictor of appreciation. And here's how. When you get to about the 0.5 RV ratio, that's what I think is sort of the equilibrium rate. What will happen in Orange County, in my prediction, is you'll have the $1 million house. It'll decline in value to about $800,000. And this is really all of California, largely. So that'll decline in value as rents creep up, and they'll sort of meet at the point of equilibrium, which will be the $800,000 house renting for $4,000 a month, 0.5. It was $1 million. It went down to 800. The rents went up from 3,000 to 4,000, and you're at the equilibrium point, and that's the sign that the market is starting to get healthy again. And then the last thing is, I want you to consider the assets you have in your life. Most people look at a balance sheet. You all, of course, know what a balance sheet is. On one side, it's got your assets. The other side, it's got your liabilities. But one of the assets that people generally don't count, and they don't even think about that they have, is their credit, their ability to borrow. And in this game, as we've demonstrated to you today, the ability to borrow and leverage an investment is an incredibly good asset. So remember, when you're thinking of a balance sheet, count your liabilities, all the debt you have, but also count as part of your assets your ability to borrow. And remember, the concept of your financial life is you always want to make all your assets work as hard as you possibly can. So if you're not using your credit to borrow and put it to work for you, then it's an unused asset, earning nothing for you. I constantly have people that kind of brag about, well, I have an 800 FICO score. Well, you have no debt. Of course you have an 800 FICO score, but you're also going to end up poor, and other people are going to end up rich because you're not using that asset, your credit asset. When you buy these properties, your credit score will go down initially. It goes down, and then in about 6 months, it sort of starts to recover. So as long as you maintain a credit score above 720, you're in very good shape. But remember, their credit doesn't do anything for them unless they use it. So use your credit. It is an asset. So keep that in mind. Don't just let it sit there not working for you, all right? So what's the plan with this? Well, the plan is divide your debt strategy into stages. Stage 1 is the launch stage. When something is on sale, I don't know about you, but when something is on sale, I stock up. Money is on sale. Debt is on sale. It's on sale in not one way, low interest rates, but two ways. Ease of qualifying, and that's gotten harder, and the rates have gone up just a tad. But when I got into the business in 1985, interest rates were 14%. Yeah, it was easy. I know, I agree. That's okay. We put those up there, but we never used the easy buttons, We just thought it was kind of a cute gimmick. So when something's on sale, stock up. Money or debt is on sale. Look at folks. In 5 years, 10 years, I'll bet you people are going to say, God, I wish I had borrowed more money when it was so cheap. I wish I had taken out more mortgages when I could have done them with 5 or even 10% down. Now it's 20% down, and the rate is 10% or 14% or whatever it is. I don't know what the rates will be, but I know that now it's a mighty good deal. So in stage 1 of your wealth building plan, you stock up on high quality, fixed rate only, investment grade debt. The debt is like the booster rockets in the space shuttle. Without the booster rockets, you could never get into orbit. So stage 2 is you jettison the booster rockets. You can let them go if you want. I still don't recommend it. But really what we say here is don't jettison the debt. Use the refi till you die plan. And what you're doing here in the stage 2 is you're starting to enjoy increased rents, appreciation, and tax savings over the years. And remember, this is 5 years we're talking about, 7 years we're talking about. And then in stage 3, that's the orbit stage, where you continue to refi till you die over and over again and enjoy living on the tax-free proceeds of the refinance. So I hope you enjoyed that piece from a recent live event, and we hope you'll be able to attend one in person sometime for more and more details. But just remember that inflation calculator example that I used in the beginning. If you were to purchase $1 million worth of property, say, for example, in our network, that might be 6 single-family homes in diversified markets spread around the country so that all your eggs are not in one basket. You're spread out, you're diversified for greater safety. Now, you borrow $950,000, 5% down, just like the example I talked about earlier. And the inflation rate for the next 10 years on this interest-only loan, the rate of inflation is only 4% per year. It's really quite a bit higher than that, but that is a much longer other discussion for a future podcast. At the end of the 10 years, remember, you had an interest-only loan, so it's now 2017, 10 years in the future. Your statements still show a loan balance of $950,000. $950,000. But because of the beneficial effects of inflation, your loan balance is really only about $912,000. Your total return on inflation is about 250%. That's another way to say ROI. Remember, the traditional understanding of ROI is return on investment, and that's true, and that's a good thing to look at. And if you check out our previous podcast, ROI, some people just don't get it. We explain in depth how to calculate return on investment. But a new definition for ROI, since we're moving on to more advanced techniques here, is return on inflation. That's right, return on inflation, from the benefits of inflation. And any of our investment counselors here at our Orange County office would be glad to run a projection, a scenario, and fax or email or mail it to you or sit down with you in person of how much benefit you're getting from inflation. But remember, the inflation benefit is twofold. Number one, when you buy real estate, you're investing in an inflation-indexed asset, an asset that is traditionally a great hedge against inflation. That's one benefit. That's the obvious one. Most investors understand that. But the other benefit is that you are paying back the debt on the real estate in depreciated future dollars. Would rather have $1 million today than $1 million in 10 years. So the benefits of inflation are twofold, not just one thing, two very big benefits of it. Anyway, thank you for listening today. We appreciate you joining us, and join us for our next podcast. Should be up in the next week or so. And also, make sure you go into the archives and look at our past podcasts, especially the last few of them. I think they'll be very beneficial to you. If you have any questions, if we can help you or advise you with your investment needs, give us a call here at our Newport Beach office at 949-640-0505. That's 949-640-0505. Also, we've got some tremendous resources at our website, a whole bunch of educational videos, articles, lots of articles actually on the inflation benefit. So surf around our website for a while. It's a very deep website, a lot of content there. It's all free content. You could spend hours there, and it will really, really benefit you with your investments. And just visit jasonhartman.com. That's jasonhartman.com. Learn a lot more about the Great Inflation Payoff and a whole bunch of other terrific and beneficial investment techniques. We'll look forward to seeing you or talking to you on a future podcast. And until then, happy investing. I'm Jason Hartman. I'm here with area manager and investment counselor Linda Mully, and she just returned from Kansas City and also Grand Junction, Colorado. And Linda, tell us about what you saw in Kansas City.
Kansas City is a great market, Jason. It's very stable and solid. It's a market where there's good growth and lots of things going on, and there's some great projects there that I took a look at that I think the investors would love to hear about.
Now, one of the things we always do is you got to go buy your own house there if you want to recommend the area to clients. And, of course, you know, I'm already an owner in Kansas City. I bought a fourplex there. But tell us what you're recommending today in Kansas City.
What we have is a great single-family home, 3-bedroom, 2-bath, about 1,450 square feet for $189,900.
Brand spanking new, right?
Brand new, rent ready, close to schools, and a beautiful shopping center, big upscale shopping center called Zona Rosa, which I had lunch at and just fell in love with.
Excellent. What's the projected return on investment?
Projected investment return here is 34% based on our usual assumptions that we put on our performance projections and the loan that you could get.
Excellent. Boy, 34% annually. Don't try that in a mutual fund or the stock market. You probably won't get it. But you can do it pretty conservatively and prudently with the right real estate investments with the right structure. Linda, thanks so much for talking about the property in Kansas City.
You bet. Thanks so much.
Hey, I just wanted to announce a couple of quick things for you. If you are interested in a Platinum Properties Investor Network franchise in your area, we are now approved for franchising in 18 states. Please visit jasonhartman.com and click on the franchise link and fill out the short application. If you are able to come to one of our live events, we would love to see you and meet you in person. We've had people fly in from all over the U.S. for them. Tuesday, January 8th, we have real estate investing using your IRA or other pension plan, other qualified plan. That will be at our office here in Newport Beach, soon to be our old office. Remember, we're moving soon. And that is from 6 to 9 p.m. on January 8th. Register at jasonhartman.com for any of these events. Creating Wealth, our core program, our main educational event is Saturday, January 12th from 10 to 4 at our office in Newport Beach. We have a mini Creating Wealth on January 15th at a location to be announced in the San Diego area. So visit jasonhartman.com for details on that one. And then we have another mini Creating Wealth Wednesday, January 23rd here at our office in Newport Beach. That's a weeknight event. We have a conference call about declaring financial independence Tuesday, January 29th, and that's on the telephone, so you can join in from anywhere. Details at jasonhartman.com. Our one in a year so far Masters Weekend event. This is a very special event where we fly in experts from all over the United States. We call this the Masters Weekend, a gathering of experts, and this is planned for March 8th and 9th at our new offices in Costa Mesa near South Coast Plaza in California. So hopefully you can join us for some of those events. Also, if you are interested in career opportunities with us, our company is growing quickly and we would love to talk with you about career opportunities. Also, remember, our rental coordinator is here to help with your rental properties. If you need assistance with your rentals, your property managers, your advertising, remember, we're here to help, and we stay with you through the life of the investment. So feel free to call our office anytime and ask for the rental coordinator for assistance on your rentals. Also want to remind you, listen to our old podcast. At least go back to podcast number 13 forward and listen to all the podcasts after that. You're welcome to listen to all of them. The ones before number 13 are older, but they're also good. But the newer ones are number 13 and forward, which are really good ones to listen to. So please take advantage of that. Be sure to see appropriate disclaimers and disclosures on our website at jasonhartman.com. Remember that we are not tax or legal advisors. So give us a call on any of these issues, and remember, we are here to help, and we will look forward to talking to you on the next podcast.
This show is produced by the Hartman Media Company, all rights reserved. For distribution or publication rights and media interviews, please visit www.hartmanmedia.com or email media@hartmanmedia.com. Nothing on this show should be considered specific personal or professional advice. Please consult an appropriate tax, legal, real estate, or business professional for individualized advice. Opinions of guests are their own, and the host is acting on behalf of Platinum Properties Investor Network, Inc. exclusively.